Hello and welcome to Niaga Spotlight with me, Tehmina Kaoosji. Niaga Spotlight takes us through the week in economic analysis and future affairs. Now, this week on analysis, our spotlight is Southeast Asia's Q1 2025 economic review. So, as the global economy enters a new era of turbulence, rising protectionism, volatile markets, and cautious capital flows, Southeast Asia finds itself at a crossroads. The region's once accelerating economies are now shifting gears from expansion to endurance. On this week's Niaga Spotlight, we break down the real numbers, real risks, and real resilience behind the Southeast Asia Q1 2025 slowdown, guided by some exclusive insights from McKinsey's latest regional economic review. In brief, Malaysia's GDP dipped 4.4% from 4.9%. Philippines, lowest inflation in 5 years, but FDI fell to its lowest level since Q3 2023. Vietnam powered ahead with export-led growth and registered FDI surge 34.7 year-on-year. Thailand cut interest rates twice. Indonesia's slide to 4.9% growth threatens its ambitious 8% target under new leadership. Meanwhile, Singapore's official 2025 GDP forecast was revised down by 2%. So, what's behind the recalibration, and what does the data really tell us about the region's next economic chapter? And why are such consumption patterns diverging despite stable inflation? Let's also look at where the new sources of resilience are emerging. Joining me now online is Kamaruzaman Kamaruddin, Director of Client Capabilities, McKinsey & Company Southeast Asia, to unpack how 6 major Southeast Asian economies are navigating global macro volatility, balancing weaker exports, industrial slowdowns against pockets of strength like digital consumption and policy pivots. Very good morning to you, Kamar. How are you doing today? Thanks for joining us.
Very good morning, Tehmina. Thanks for having me on board. How are you?
Very well indeed. So let's launch straight into looking at the wider Southeast Asia macro picture, Kamar. Now, McKinsey, of course, recently published your quarterly economic review of Southeast Asia for Q1 2025. What are some of the key takeaways you can share with us?
Yeah, sure. So we published our first quarter 2025 report in June this year, and we saw 3 key takeaways, right? So one, there was a soft start to 2025. Second, we saw resilience. And third, we saw smart policy pivots. So essentially, the start to 2025 was a soft one. Most Southeast Asian economies saw moderation in terms of GDP growth, which is impacted by external challenges such as trade tensions and policy uncertainties. Philippines was an exception. It grew faster by 0.1%. And overall, Vietnam still led performance, although it recorded its lowest growth in 3 quarters. Despite the soft start, resilience was also part of the story. So domestic demand held firm, especially in the Philippines and Vietnam, which effectively helped to buffer against the impact of external global uncertainties. Inflation remained largely contained, so staying within target range across most markets. And third observation, we also saw smart policy pivots. So essentially here, policymakers moved early. Central banks in Indonesia, Thailand, and the Philippines all cut rates. And Singapore as well eased its monetary policy twice. So currencies rebounded after early weakness. So the Sing dollar, Malaysian ringgit, and the Philippines peso all gained against the US dollar. So I think just to recap, Southeast Asia kicked off 2025 on a softer note, but yet it remains versatile and resilient. Fundamentals are sound, and there were support from smart policy pivots.
Absolutely. I think that's very well expressed and observed as well, with those main slowdown factors being a lot of discussion around trade tensions, policy uncertainty, so lots of headwinds which have eroded a little bit of investor confidence. But moving along, of course, you have described the region as resilient. What gives you confidence in this outlook, though?
Yeah, so I think here, allow me to first share a brief context, right? Global headwinds has been ongoing for a while. And so despite that, the region's growth still continued to accelerate and pretty much held up until early this year, which is first quarter, where we see a bit of a softening across the region. So essentially, what gives us confidence in Southeast Asia's resilience stems from a couple of factors. One, we see that most economic indicators are still holding up, especially domestic cushions. So in the case of Philippines, for example, it grew faster in Q1, driven by very robust household consumption and remittances. In Vietnam, domestic demand continued to remain firm. Second, there is still room for policy support if needed, right? So inflation is contained, which has allowed for and will further allow central banks to act if it needs to prop up the economy. Currencies are strong, which indicates that markets are confident and trust the region's policy and fundamentals. And I think the third point, which is important as well, is that investors are voting with capital, right? So they are really walking the talk. And just to share an example, over 30 billion USD was committed into data center projects in just the first half of 2024 alone across Singapore, Malaysia, and Thailand. So I think just to sum it up, we feel confident that Southeast Asia isn't just resilient, it is adapting, and I think beyond that, building for the future as well.
Absolutely. There's a real anchoring of the region as a financial FDI central hub amid all this global turbulence as well. Now, of course, we mentioned and briefly touched on trade tensions, geopolitical issues, which are still ongoing, Kamar. Now, how exposed is Southeast Asia overall to this global volatility?
Yeah, I think that's probably a question top of mind to many. So Southeast Asia is directly exposed to global volatility, right? The region is made up of open economies that are deeply connected to global trade and supply chains. It will be impacted by US-China tensions, shifting trade flows, amongst others. So meaning what happens in big markets like the US, China, or even Europe, right, would have a direct impact here. So if global demand slows, it will affect our exports. If supply chains are disrupted, factories in Vietnam, Thailand, Malaysia can feel it right away. And in fact, on the topic of volatility, our latest McKinsey Global Economics Intelligence Report also shows that trade disruption and policy shifts are in fact top concerns amongst global leaders. But I think in the midst of volatility, we are also encouraged that Southeast Asia is diversifying, and we believe that it has a unique edge here. So in terms of diversification, Southeast Asia is pursuing new engines of growth. So let's take Malaysia as an example. So we saw the recent push in AI and data centers. Beyond that, it is actively expanding trade partnerships. And as ASEAN leader for 2025, it is also actively enhancing regional cooperations. These are good signs. And beyond that unique edge, what we meant by this is that Southeast Asia has a unique edge because if we think about it, it is the only region where both American and Chinese tech ecosystems can actually operate side by side. So you see companies like AWS and Google competing directly with Alibaba and Tencent in the same markets. You don't see this elsewhere. And that makes the region more than just a place that reacts to global trends. It's actually a live testing ground for innovation, right? So meaning what works here could effectively shape the future of tech globally. And I think we see this as being something encouraging and exciting. So the region is not just weathering volatility, it is also becoming more important on the global stage and essential as to how the world realigns itself.
Absolutely, and this deep integration into global trade networks is actually going to serve us most likely extremely well over the next decade to come. Now, moving into regional currencies, it has been noted in the McKinsey report that they have all regional currencies have rebounded in Q1. What's behind this trend, and what does it perhaps signal?
Yeah, I think it's a good question. So, I think first and foremost, FX markets are often the bellwether of the economy. So rebound in most regional currencies is effectively a positive signal for the region. In Q1, what we saw was that inflation stayed mostly within target, which reinforces macro stability in the region. And that gave room for central banks to take early actions and ease rates to stimulate economic growth, right? So, example, Singapore Central Bank eased twice, and as a result, Sing dollar was one of the Asia's top performing currencies, which is a vote of confidence, or rather, vote of investors' confidence in its fundamentals. Beyond that, currencies like the Malaysian ringgit, the Philippines peso also strengthened against the US dollar. So overall, stronger currency is a positive sign. They are signaling investors' confidence in the region, and that Southeast Asia is effectively seen as a safe and steady investment zone.
Exactly. And I think it also speaks of stabilizing commodity prices together with modest inflation that has helped improve this outlook, especially the confidence of central banks as well. Thank you, Kamar. Now, looking across the region, though, which sectors or industries are actually showing strength despite the macro headwinds that, of course, are going to be ongoing?
Yeah. So, well, I think we already see that export-oriented sectors such as manufacturing took a hit. But what we are also seeing is that domestically anchored, consumption-based, and digitally enabled sectors are showing strength, and it actually helped to steady the ship. I can highlight a few sectors or industries here that are showing strength. Example, consumer and healthcare. So consumer goods remain resilient, supported by continued consumption and a growing middle class. Healthcare is also robust, with growing demand for medical services and an aging population. Finance and digital services have remained strong. So finance, insurance, e-commerce continue to grow. Tourism is another area, especially in Thailand and Vietnam, clearly benefiting from international tourism. Public infra-linked sectors holding up as government infrastructure spending remains steady. And in Q1 specifically, we saw an uptick in agriculture as well, driven by strong consumption and improved crop yields. So I think even with the softer regional outlook, several sectors remain bright spots, and which does back to the point around the region's resilience and its ability to continue growing despite the external shocks.
Absolutely. And also, for example, if you just zoom on in, this domestic demand and output as well. Indonesia, for example, really benefited because agricultural exports helped to offset their mining declines. In the Philippines, of course, service and consumption remaining a growth backbone. So I think it's also speaking positively towards the larger sized Southeast Asian economies as well. Thanks for the insight so far, Kamar. Let's perhaps now segue into looking a little more closely at Malaysia. Now, Malaysia's GDP, of course, moderated in Q1 2025. Would you say this is part of a broader trend or something more domestically linked?
Yeah, so growth in Malaysia's Q1 GDP did moderated, and this reflects both global and local factors at play. So globally, there was a slowdown in terms of demand and obviously trade tensions. That impacted growth across export-dependent economies, particularly in sectors like electrical and electronics, commodities, for example, and that weighs down on manufacturing and also mining sectors in Malaysia. If we switch lens to locally, consumption growth moderated. So despite strong labor market conditions and policy support, such as the targeted subsidies, cash transfers, minimum wage revisions, it didn't have that much of an effect on consumption growth. But let me steer us towards an even bigger story for Malaysia, right? It's actually in investments. So investments, if you look at it, is significantly stronger than what we saw a year before. So just highlighting a few examples, Microsoft is investing 2.2 billion USD. Google is investing 2 billion USD into Malaysia to build large-scale AI and cloud infrastructure. I think these are positive signs that could position the country as an emerging player in ASEAN's digital economy beyond just being an exports hub.
Absolutely. Thank you for those insights. Now, also private consumption then in Malaysia, it showed modest growth, but exports were still weak. What could perhaps turn this around, while of course remaining cognizant that we're having plenty of FDI coming in too?
Yeah, so the growth in Malaysia's consumption and exports both moderated in the first quarter. And there are three potential levers that can potentially help turn this around, right? So there need to be, number one, stronger household sentiment and confidence. There need to be accelerated, or rather an acceleration in terms of investment execution. And there need to be a diversified, or rather diversification in terms of export markets. So maybe let me just explain a bit further here. So in Q1, there were policy support measures such as the civil sector pay hikes, minimum wage revisions. Perhaps we could consider fiscal support for the B40 group to, also help further sustain consumption. And beyond this, and which is also equally critical, right? We need to see real wage growth and better job matching, essentially, which are needed to boost spending further. Second point, there need to be a push to accelerate investment execution, especially in digital and infrastructure areas, which will have spillover potential in terms of boosting SMEs, in terms of creating new jobs as well. And to the last point around exports diversification, Malaysia could diversify beyond its reliance on China and the US. So, for example, by building deeper regional supply chain linkages across ASEAN region, right? So that could be one example. So those are three potential levers that can potentially help boost consumption as well as exports.
And of course, trade policy clarity would certainly help in the immediate to medium term. But in the meanwhile, it does bode well for Malaysia to be also expanding our lens on non-traditional markets. Thanks, Kamal. Now, with Bank Negara easing rates, what impact can we expect on consumer confidence and business investment in Malaysia for the time to come?
Yeah, so Bank Negara recently adjusted rates, and the easing of rates by Bank Negara could have a potential impact, positive impact rather, right, on consumer confidence as well as business investment. So it eases financing conditions and could stimulate borrowing and investments to prop up the economy. So here we can look at it from two lenses. One, the consumer lens, and second, the business lens. So for consumers, lower interest rates will reduce borrowing costs, which in turn could unlock major purchases such as homes. It could also help unlock consumer spending to boost consumption. For businesses, cheaper credit can facilitate expansion and investment in new projects, such as investment in new plant, investments in technology, which will then have a knock-on effect in terms of supporting a pickup in production as well as growth. So in short, easing of rates could drive growth, and if public and private investments ramp up in tandem, we could see growth momentum return in the second half of 2025 this year.
Absolutely. And also with both consumer confidence and business investment, there comes the offsetting of any kind of external headwinds and providing at least that short-term cushion while we realign overall as a nation. Shifting our focus now to Singapore. Now, Singapore's economy contracted, but currency was actually one of the best performers. How would you explain this duality?
Yeah, so Singapore's contraction in Q1, or rather a growth moderation, right, if we compare Q1 on a year-on-year basis, was primarily due to weaker external demand. And that impacted manufacturing output, especially in sectors that are sensitive to global demand fluctuations, such as biomedicals being one. Yet, the Singapore dollar was one of Asia's strongest currencies. It rebounded against the US dollar by end of the quarter. And the strength in its currency reflects a combination of factors. One, it reflects investors' confidence in Singapore's economic fundamentals. and its status as a global financial hub. Second, it is also a positive investor perception of Singapore's policy stability and reliable regulatory framework. And third, it's also a recognition of Singapore's proactive monetary policies and its strong financial reserves. So this is overall a positive testament to Singapore's economy. Despite the external headwinds, investors remain confident in Singapore, which in turn helped to maintain the currency stability that we saw.
And perhaps some notes to take for regional monetary policies as well. Moving into Thailand then. Thailand's economy, though, shrank quite sharply in Q1. Now, is this just tourism underperformance, or what deeper issues might there be at play?
Yeah, so Thailand's economy has been the lowest performing economy in the region for a couple of quarters. And in Q1, we saw growth moderated from 3.3% in the fourth quarter, 2024, to 3.1% in the first quarter this year. And there were two key contributing factors here. One, slow consumption, and two, we saw, or rather, manufacturing performance continued to be tepid. So in terms of consumption, consumption growth basically slowed across all spending categories. Consumer confidence is low, household debt is high, nearing 90% of GDP, and this obviously limits spending capacity and numbing the impact of stimulus measures. Second point around tepid manufacturing performance, Thailand's manufacturing sector contracted for a long time before finally turning a corner in quarter 2 2024. But even since then, growth has been tepid. So if we look at quarter 1 2025, manufacturing grew by 0.6%. Auto sector, which is a key sector for the country, has been a drag. Production dropped for 21 consecutive sectors. And beyond that, there are also reports that 100 factories are closing down every month since 2021 due to cheaper Chinese imports and slower consumption. So, there are growing calls for Thailand to reform its manufacturing sector and shift towards high value added industries. And on the upside, Thailand has long-term advantages in areas such as renewable energy, EV production, among others, which is backed by foreign investment and local manufacturing capacity. So perhaps with stronger execution and coupled with recovery in key sectors like tourism, Thailand may be positioned for improved growth in the second half of this year.
And very much so, the emerging picture is that it is structural drag, not just seasonal tourism dips contributing to this overall current slowdown for them. Now, moving across to Vietnam then, Kamar. Vietnam is, though, often seen as a standout performer in the region. Is that still the case for 2025? And what is actually fueling this specific resilience for them?
Yeah, absolutely. Vietnam remains one of the strongest and most resilient economies in the region, even though growth moderated slightly in early 2025. So what's keeping Vietnam ahead are three powerful drivers, right? So one, it's FDI. Second, it's manufacturing strength. And third, domestic demand. So FDI continues to flow steadily into Vietnam. Global companies are increasingly seeing it as an alternative to China, especially in electronics, semiconductor, textile, and green tech, among others. Vietnam has got a young workforce, investor-friendly policies, and strong logistics infrastructure to make it a go-to investment decision. Manufacturing continues to be a strength and a core engine of the economy. So even as exports face global headwinds, Vietnam's position in global supply chains is holding firm. So high-tech manufacturing like smartphones, electronics, components continue to anchor its exports performance. And the country is gradually moving up the value chain, which could boost productivity and wages. Third point, domestic demand is also proving to be a shock absorber. So a growing middle class, strong retail activity, and rising urbanization are helping consumer spending healthy. And Vietnam's internal market is also becoming more important to help cushion against a slower global trade, right? So yes, growth has slowed a little, but Vietnam's fundamentals are still strong and the momentum is still very much intact.
Clear signs of resilience there. Moving across to now Indonesia. Indonesia shows a smaller than expected contraction though. How could this convert to its population size and resource wealth into then perhaps digital-led productivity gains to make up?
Yeah, so Indonesia's Q1's growth moderated smaller than expected, but the country's economic fundamentals and scale will give it significant long-term opportunity. And to fully unlock productivity gains, we have identified 5 potentials enabling capital, right, that Indonesia must invest in. 1, physical; 2, human capital; 3, technological; 4, natural; and 5, institutional capital. And maybe let me explain the first 3 a bit further here. So in terms of physical capital, I think Indonesia has to invest into providing better infrastructure, so better roads, ports, efficient cities, and logistics to move people and goods faster. In terms of human capital, there is a need to upskill workers to ensure that they are digitally literate and also having more hands-on training in new job skills to succeed in future economy. And in terms of technological capital, we should be helping SMEs and traditional companies go digital, use cloud, and adopt automation. So we're already seeing signs of this. For example, Indonesia's mining sector is piloting AI. And there was also a recent announcement in Asia's first quantum AI data center in Indonesia. These point to bold steps in tech capital, which is great, but scaling the 5 capitals simultaneously is what that will really enable Indonesia to transition from size to productivity and from potential to performance.
And also the perhaps digital upgrades in mostly tradable sectors to be boosting resilience. Very quickly now, if we could run through your perspectives on Philippines being the only country to post GDP growth in Q1. What has been driving that momentum?
Yeah, so the Philippines was the only Southeast Asian economy to post faster pace of GDP growth in Q1. And this resilience was largely domestic-led. Household consumption remains strong, supported by continued overseas remittances, which rose year on year. And beyond that, a couple of other additional support factors. 1, strength in manufacturing, especially food production, which contributes half of Philippines' manufacturing output. We saw a turnaround in agriculture. Beyond that, strengthening of the peso and coupled with stable inflation, which reinforced purchasing power. And we also saw robust growth in digital economies, such as economic sectors such as e-commerce and fintech. So as long as domestic consumption holds and inflation stays under control, the Philippines should be well positioned to sustain momentum through the rest of 2025, and even beyond that, gradually shift towards more of a digitally driven growth model.
Thank you for that. And to just end out very quickly, Kamal, we'll fast forward to the next quarterly report. What indicators will McKinsey and you be looking at, watching most closely across Southeast Asia?
Yeah, so the next quarterly report will be an interesting one. So that period coincides with the US Liberation Day tariff announcements. I think first and foremost, we will be watching top-line growth signals, which will provide us with a good gauge in terms of where the region will be headed in the near term. And it could turn out to be a surprise quarter, right? Vietnam, Indonesia, the Philippines have already released their Q2 GDP results, while Singapore has released its advanced estimates. And all countries recorded GDP growth acceleration in Q2, which is very positive given the current climate. And beyond that, we will also be keenly watching on 3 other indicators. 1, trade volume, especially exports, to understand the immediate impact of tariffs and global demand. Consumption as an indicator of domestic demand and consumer confidence, especially in consumer-driven countries such as Philippines, Indonesia, and Thailand. FDI flows as well, which will provide a gauge of investor confidence and emerging bets or priorities. So above all, we are looking for signs that Southeast Asia resilience is turning into momentum, not just buffering shocks, but also building new engines of growth.
Thank you. Thank you very much, Kamar, for all your excellent insights. So clearly it's looking like the path forward for Southeast Asia is looking at digital futures, resilient trade, as well as homegrown confidence. Well, I'm Tehmina Kaoosji signing off for now. This has been Niaga Spotlight, and that's all we have time for today. We'll see you again next week with more economic analysis and insights. Here's to a productive week ahead.